Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In this episode, I'm going to do a deep dive on investing in bonds. It's a topic I've received almost daily. Emails, should we invest in bonds? Yields are really low, interest rates are really low. Won't bonds lose a lot of value when interest rates rise? How should we handle this? So I'm going to walk through really from beginning to end. So if you're new to investing or if you've been investing for a long time, I think this could be useful to you. I will include timestamps below the video so that if you want to jump to specific topics, you can. So here's what we're going to do. Going to start with the basics, what a bond is and some key terms that you need to know. Going to briefly touch on tax issues. And then going to talk about how bonds gain in value or lose value. How do we make money on bonds? And it may seem obvious, interest payments, right? But it turns out it's a bit more complicated than that. So we're going to talk about how they make money and lose money. Of course, we're going to talk about bonds linked to inflation. That's I bonds and TIPS. And then I'm going to share with you why I believe just about every investor should have some exposure to bonds. That's my view, and I'm going to tell you why. And then I'm going to look at some specific strategies on how to invest in bonds. We're going to look at some specific ETFs and mutual funds that I like, but more than just individual funds, how we can put them together in a way that makes sense in a bond portfolio, whether you're in your 20s and just starting out, or you may be a little older like I am and are getting close to retirement. And I do think that matters, how we want to think about our bond portfolio. So with that, again, timestamps below the video, and I'll also have links to all the resources I show you below the video as well. So with that, let's dive right into it. And a bond is really nothing more than debt, right? As a bond investor, we are lending somebody money, and they're paying us some interest, hopefully, on the money we lend them, and then eventually giving us our money back, what we've loaned to them. And so when it comes to a bond, you can kind of think of three sort of key factors. The first is what is known as the issuer, who's issuing the bond. In other words, the borrower. And then there's the maturity. How long will this bond last? We get interest payments for a certain number of years, and then it matures, which means it's done. They give us our money back. You could almost think of it like the term of a certificate of deposit. The term is up, and we get our money back. And then there's the interest rate on the bond. Sometimes it's referred to as a coupon rate. So those are sort of the three factors. Let's briefly touch on them. With the coupon rate, you might say, what's up with that term? So back in the day, bonds were paper, right? Before we had computers and electronic securities, it was a physical certificate, and it had little coupons. You'd literally cut them out each time an interest payment was due, and you'd present this coupon to the bond issuer, and they would give you your interest payment. And that term is sort of hung around, even though we don't really use coupons anymore, so you might see that. But it's nothing more than the interest rate. And in most cases, there are some exceptions we'll look at. In most cases, the interest rate on a bond is fixed. So if the U.S. government issues a 10-year Treasury bond and pays 1.5%, for example, that's a fixed rate for the life of the bonds. That's it. That's the coupon rate. Remember, I mentioned issuer, who's actually borrowing the money. And here we can think of issuers really in three categories. There are countries like our U.S. government that issues bonds, and they're just called government bonds. We focus a lot and will in this video on U.S. government bonds, but of course, countries all over the globe issue bonds. So that's the first category. And then the second category would be, think local governments, state governments, city or towns. And these are called municipal bonds, or munis for short. And then the third sort of broad category of issuers would be corporations. Companies borrow money. Sometimes they borrow it from a bank, but many times they will issue bonds to the public. And those are simply called corporate bonds. And the reason it matters, who's actually borrowing the money, is because as a lender, we want to know, do you have good credit, right? Are you going to pay us back? Are you going to pay the interest payments year in and year out? And then when the bond reaches its maturity, are you going to give us our money back? And here, there are different rating companies that rate everything from companies to countries. And in fact, let me just show you what that looks like briefly. This is actually just from Wikipedia. And again, I'll include links below the video. But the three major rating firms are Moody's, Standard & Poor's, and let me just make this a little bigger for you if I can. There we go. Moody's, Standard & Poor's, and Fitch. And you can see they follow similar but slightly different rating scales. Sort of the key for us, if you can see it right here, this white line that goes all the way through. If we look at, for example, Standard & Poor's, just above it is triple B minus and just below it is double B plus. That's sort of the line that distinguishes between what's called investment grade bonds, that would be all the ratings above the line, with non-investment, or sometimes referred to as high yield or even junk bonds below that line. And so that's pretty important. And we can actually see this at work with countries. These are not just ratings for companies. Moody's, Standard & Poor's, and Fitch rate countries as well. And we can actually see a list of it right here. Again, let me try to make it a little bigger for you. And it shows you, in this case, this is Standard & Poor's ratings for each country that's been rated. And actually, you know, you might think, well, if AAA is the highest, and let's go back to our credit ratings, we can see AAA is the highest for all three of them. You might assume the United States government is AAA. But if we scroll all the way down, here we go, it's actually AA plus for Standard & Poor's, which, come back over to our rating list, it's number 2, and that might surprise some of you. They actually downgraded the US government, about a decade ago, as I recall, for a combination of high levels of debt relative to GDP, but also the whole fight over the debt ceiling, which comes up now and again. But here's the thing, as a practical matter, regardless of what the rating agencies do, the market views US government bonds as basically risk-free, that there's no risk of default, that at worst case, the government, US government, could just print its own currency and pay the interest payments and eventually return the principal amount to bondholders. So US government bonds generally considered risk-free. And then other bonds, depending on whether it's a different government, a local government, a corporation, can have varying degrees of credit risk. And we'll take a look and see how that impacts bonds later in the video. The thing to really understand is this. The lower the credit risk, all other things being equal, the lower the yields, right? You're willing to accept a lower interest rate because the bond has less risk of default. On the other hand, as the risk of default goes up, well, investors typically demand higher rates to account for that risk. And so that's, in a nutshell, the coupon rate and the different kinds of issuers. I mentioned maturity, and let's talk about that briefly. Maturity, again, you can think of it like the term of a certificate of deposit. It's how long the bond lasts, where you'll get your interest payments during the term of the bond, and then when it matures, the borrower will give you back the money that it borrowed. And terms, maturities vary. They can be as short as a few weeks. They can be as long as 100 years. They have century bonds. And we tend to categorize maturities as either short-term, intermediate term, or long term. Generally, short term would be a couple of years or less. Intermediate term would be from that point maybe up to roughly 10 years, might be considered intermediate term. And long term would be roughly anything greater than 10 years. And we can actually kind of see that in action with US government bonds. Let me show you this. This is from treasurydirect.gov, an excellent resource for information on US government bonds. And here some terminology is helpful, because you'll notice I'm looking at what are called Treasury bills. And if we come over to the sidebar here, you'll see there's a link for Treasury bills, Treasury notes, and Treasury bonds. And that can be confusing, because the fact is bills and notes are also bonds. What they do is they give them different names so that we know just from the name itself whether we're talking about short term, intermediate term, or long term. So Treasury bills, definitely short term. You can see right here, Treasury bills are short term securities maturing in 1 year or less. And again, this only applies to U.S. government bonds, this terminology. So that's a Treasury bill. If we go over to Treasury notes, you can see here Treasury notes are interest-bearing securities with a fixed maturity of not less than 1 year, but not more than, you can see it here, 10 years. And at the moment, the Treasury is issuing notes in 2, 3, 5, 7, and 10-year maturities. And then if we come over to the bonds, that would be maturities over 10 years. So that's why you'll often see those terms, Treasury bills, notes, and bonds. And now you know what they mean. Generally speaking, the longer the maturity, the higher the interest rate to account for the risks associated with locking your money up for a longer period of time. Now, that's not always the case. Sometimes we find shorter term bonds actually yielding more than longer term bonds, but generally under normal conditions, the longer the maturity, the higher the yield. Now, before we move to the next section, very briefly, let's talk about bonds versus savings accounts and CDs, because I get this question a lot. I think generally they can all be described as what would be called fixed income investments. Savings accounts, and let's talk about savings accounts. They're demand accounts, meaning you can get your money back anytime you want. It's not like buying a bond that has a 10-year maturity. Now, of course, you can sell that bond. We'll talk about that in a minute. But you're investing in a bond that's not going to return your money, at least the amount borrowed. You'll get interest payments, but not the amount borrowed in that example for 10 years. But with the savings account, of course, you can get access to your money anytime. And so you can imagine, if we think about it in terms of maturity, it has a maturity of like 0, if you will. So it's on the absolute low end of the sort of maturity, I guess, scale or range. You could think of it that way. And savings accounts and certificates of deposit as well, I think, can be an important part of a fixed income portfolio, particularly for those near or in retirement. Now, the yields right now, the interest rates that you're going to get on these products, as you no doubt know, are not very good. I'll leave some links below the video, but on a savings account, probably the best you can do as of recording this video is somewhere around 60 basis points, maybe a tad more. That's like 0.6%, not much. That's less than 1%. The rates on CDs are not much better. Of course, if you're willing to lock your money away on a CD for longer terms, you might get slightly higher interest rates, but right now they're not particularly good at all. Now, before we talk about how bonds gain and lose money, I want a quick comment about taxes, and specifically to begin with municipal bonds. So municipal bonds, or munis as they're called, remember, these will be local governments, your state, cities, sometimes different local government entities, think a hospital, for example. They're not subject to federal income tax. So you won't pay federal income tax on the interest you earn on a municipal bond. And in some cases, they may be exempt from state taxes as well. Now, what does that mean? Well, it means that in exchange for that tax treatment, that beneficial tax treatment, all other things being equal, the interest and yields on a municipal bond are going to be lower than other bonds that are taxed. So what does that mean for you and I as investors? We don't want to hold a municipal bond fund in a tax-advantaged account. We don't want a municipal bond fund in a 401k or an IRA because we're not paying taxes, at least while we're investing on those accounts. So we wouldn't get the benefit of the tax-free status of municipal bonds. The second thing it means is that municipal bonds become more valuable to those investors in really high tax brackets. So if you're in the top federal income tax bracket, and particularly if you're in a top bracket in a state like New York or California, and you can invest in some municipal bonds that might even be exempt from state tax, you're going to have a really significant advantage potentially with municipal bonds. On the other hand, if you're in the lowest tax bracket at the federal level, they may not be as valuable. The other thing I want to mention before we move on is with treasuries, like we've just been looking at a few minutes ago, they are subject to federal income tax, but not state and local taxes. So that's something to keep in mind. Now, as we sort of turn now to how in the world do bonds gain and lose money, we need to talk about a key term. We've talked about the coupon rate. That's the actual interest rate that a corporation or government's going to pay on the bond. And again, normally that doesn't change. We'll look at an exception in a minute, but normally that doesn't change. But the yield is now something very different. And I think the easiest way to understand the yield on a bond is to think about the dividend yield on a stock, right? So if you think about, let's imagine Apple, for example. Let's assume it pays a $1 annual dividend. And we'll just assume for the moment it's trading at $100. Well, what's the dividend yield? Well, it's just simply the amount of the dividend, $1, divided by the price of the stock, $100 in our example, it's 1%. But here's the thing to keep in mind, that yield will change, right, as the price of the stock changes, even while the dividend amount itself stays the same. So for example, let's just imagine our $1 dividend, and it's a $100 stock price. Let's imagine the stock doubles to $200, but the dividend still stays at $1. What happens to the yield? Well, 1 divided by 200 is now 50 basis points, or 0.5%. So even though the dividend itself didn't change, as the price of the stock went up, the dividend yield went down. And the opposite is true, right? Let's imagine the stock got cut in half from 100 to 50. Again, the dividend stayed the same, $1. Well, now the dividend yield is 2%, right? 1 divided by 50. So as the stock price goes down, the dividend yield goes up, even while the dividend, again, in all of these hypotheticals, hasn't changed. Well, the same thing is true with a bond. If we imagine a bond that's paying a coupon rate of 1% on a $100 bond, if the value of that $100 bond goes up, well, the yield goes down, right? We can just take that, the interest we're going to get. Remember, the interest hasn't changed. So we can take the interest we're going to get divided by that higher bond price, brings the yield down. And the reverse is true as well. If the bond price goes down, the yield goes up. And it's here where it seems kind of odd to think about a bond changing value. We all understand how and why stocks change value from day to day. But I mean, on a $100 US Treasury bond, if we're going to get interest for some period of time, and then when it matures, we're going to get our $100 back, it seems odd to think that the bond itself would be bought and sold for anything other than $100. But in fact, that's exactly what happens. And I can show you an example of that, and then we'll look at why it happens. We're back on the Treasury Direct website, but we're looking at a different page. Again, I'll leave links to all of this. And we can see we've got our bills here, and notes and bonds, among a few other things. Just like we looked at a minute ago, let's start with notes. And we'll just look at notes. Remember, these are intermediate term US Treasury bonds. And we'll look, this one's a 7-year term, so it matures in 7 years. And we can see over here the interest rate. So that's the interest rate the government's going to pay. That will never change. It doesn't matter what the bond sells for. You know, you could pay more than $100 or less. You're still going to get 1.5% of $100, assuming a $100 bond. But notice the yield. The yield's a bit higher. When this bond was sold at auction, it yielded what they call a high yield of 1.588, slightly more than the interest rate of 1.5. So what does that tell us? Well, remember, as prices go up, yields go down, and as prices go down, yields go up. And since this yield is higher than the interest rate, that tells us this bond sold for something less than its face value. And we can actually look at it. We can look at what's called a CUSIP number. This is sort of a unique identifying number for securities in North America. If we click on that link, we'll look at this. We can see it just sold a few days ago. And for every $100, yep, the price went down. It sold for $99 and change, right? And so that gives you sort of a real world example, come back to notes, of interest rates and yields and this idea of bonds selling for, in this case, less than their face amount. If we come over to tips, we haven't talked about tips. I'm just going to show you this briefly. We're going to come back to tips. Here, the opposite's happening. The interest rate is 0.125%, but the yield is negative. And if we look at the CUSIP, we can see, sure enough, for every $100, they paid, look at this, in one case, over $115 for every $100 in this case in tips. So it can go both ways. Again, we'll talk about tips in more detail in a minute. And that all of this, though, raises the question, why do bond values go up and down? Why are some bonds sold for below face amount? Why are some bonds sold for more? And then these begin to trade on what's called the secondary market, just meaning between investors like you and me, and they're going to almost always trade for more or less than the face amount of the bond. And that we need to understand why. Why does that happen? And it happens for two reasons. First of all, interest rates change. The current rates on a bond change daily, and credit quality. That is the risk of default. So let's talk about both of them. As interest rates change, the yield on a bond is going to change as well. So as interest rates go up, the value of the underlying bond goes down. And as interest rates go down, the value of that existing bond go up. And to understand why, let's just imagine we have a 10-year Treasury, we own it, and it's paying, let's make up a number, we'll say it's paying 1.5%. And let's say interest rates go up, and so that an investor can now buy that same bond for 2%, for a 2% interest rate or coupon rate, and you've decided you want to sell your bond that's earning 1.5%. And you want to get the face value of the bond, $100, let's say. Well, why would someone buy your bond for $100, earning 1.5%, when they go out and buy a new bond just like it and get 2%? Well, the answer is they wouldn't. And so the only way to get someone to buy your bond, if you really want to sell it, is to lower the price. And so that the price or value of that $100 bond is going to have to go down so that when you apply the 1.5% interest rate to it, they get the net effect of the current interest rate, in our hypothetical 2%. Now you could say, well, in that case, I'm just not going to sell the bond. Fair enough, except that still the value of the bond has gone down. That's true whether you end up selling it or not. And then the opposite could happen, right? Your 1.5% bond, maybe interest rates go down to 1%. And so now people are actually willing to pay a premium for your bond because it pays more than the current rates. So the real takeaway is this. As interest rates go up, the value of existing bonds go down. And as interest rates go down, the value of existing bonds go up. And by the way, we're going to talk about this. That's what has bond investors so scared. Interest rates are so low, it seems like the only way they can go is up. And when that happens, aren't we going to lose a lot of money in the bond market? That's the real question. We'll get to that in a minute. But the other thing that can cause the value of bonds to go up or down is credit quality. That is the risk of default. And so, with U.S. government bonds, as I've mentioned, they're generally considered to be risk-free. So credit quality, by and large, doesn't factor into U.S. government bonds. But imagine corporate bonds, even investment-grade corporate bonds. There is some risk of default. That is, that a corporation falls on hard times and can't pay either the interest on the bonds or even the return of the principal when the bond matures. And think about our economy maybe going into a recession. And when that happens, credit quality tends to deteriorate and the value of bonds can go down. And we actually saw that when COVID hit us in the early part of 2020. So both interest rates changing up or down can affect the value of existing bonds, and so can credit quality. Now, here's the big takeaway from all of this, is that when we think about investing in bonds, we tend to focus on the yield, and that's important, but we have to understand that the overall performance of a bond is not just the yield. It's also this change in the value of the underlying bonds that we've talked about. In that sense, they're very similar to stocks. We may look at the dividend yield of a stock or stock fund. That's great, and that's certainly part of our return. But so is the underlying value of the stocks as they go up and down. And in fact, we can have a very high dividend yielding stock or stock fund, and over certain periods of time, still lose money. And we can also have stocks that don't pay any dividend at all, and we can still make money. And the same is true with bonds. And I'll show you briefly just a quick example of this. We're going to go over to Morningstar, and we are looking at the Vanguard Total Market Bond ETF. Let me refresh this. And this is ticker BND. And we'll notice that over the last 12 months, we can see it right here, this bond's yield, and we know what yield is now, right? It was 1.9%. But that doesn't tell us how the bond actually performed. For that, if we go to the Performance tab right here, we can see that over the last, I'm recording this in December, so year to date, this is roughly 11 months, it's actually lost money, 1.1%. And the year before that, it actually gained 7.71%. So yes, the yield is important. We've talked about it. We're going to talk about it some more, but don't confuse yield with the overall performance of a bond or bond portfolio. In fact, as we'll see, you can have bonds that have a negative yield that actually have a positive return. We're going to look at an example of that in just a little bit, and that is I bonds. So we've talked about interest rates, how if they go up, the value of bonds go down, and if they go up, the value if interest rates go up, the value of bonds go down. If interest rates go down, the value of bonds go up. That's fine. But now the question is, well, by how much? What are we looking at? And so there's a couple of sort of rules of thumb that we can use to assess how rising or falling interest rates will affect a bond, say ETF or mutual fund. So here's what we're going to do to show you that. We're going to stick with, for the moment, BND. Again, it's just a Vanguard Total Bond Market Fund. And we're going to go over to the Portfolio tab here. And we want to look at what's called the effective duration. And the concept behind duration is easy, I think, easy to understand. Remember, we've talked about maturity. That's when the bond matures and you get all of your money back. But we don't have to wait, let's say in a 10-year Treasury bond, for example. We don't have to actually wait 10 years to get all of our money back, right? I mean, that's when we get the principal amount, the amount of the bond itself back. But we're getting money back every year in the form of interest, right? It may not be much right now, but we're getting interest in years 1 through 10 as well. So while the bond matures in our hypothetical at year 10, we're getting money along the way. And so what duration effectively tries to do, and there are different ways to calculate duration, but just from a conceptual perspective, it says, what's the weighted average time that it'll take for me to get all my money back? So I get a little in year 1, a little in year 2, all the way up to a little interest in year 10 plus the principal amount. If we were to calculate some weighted average, what would that turn out to be? And that's duration. Now, one thing to think about is that you can have two 10-year bonds, same maturity, that have different durations. And how is that possible? Well, if one has a higher yield, the higher the yield, all other things being equal, the lower the duration, because that higher yield is generating more interest. You're getting more money back. Imagine a bond paying 10% versus 1%. Well, I'm getting a lot more money on that 10% bond each year, and that brings down duration. All right, so what does duration tell us? Well, in this case, for BND, the effective duration is 6.83 years. That duration is measured in years. And so generally what that tells us is this. For every increase in interest rates of 1%, the value of the bonds in this portfolio will go down, because remember, as interest rates rise, value of bonds go down, will go down by the amount of its duration, 6.83%. If interest rates fall by 1%, the value of this bond will go up by 6.83%. Now, again, different bond ETFs and mutual funds have different durations. Some are longer than this one. Some are much shorter. We'll look at some different ones in just a minute. Now, just briefly, I want to just say that rule of thumb is a rule of thumb. Depending on the exact type of mutual bond fund and exactly where the yields are, it won't actually follow that rule of thumb completely. There's a concept called convexity. I'm not going to go into details of it, I'll leave some links below the video, but I mention it only because you may come across it from time to time. And the idea is that at different spectrums of the yield curve, when interest rates rise, the values may fall less than expected, or maybe more than expected. It's not a concept that, frankly, I think 99.9% of bond investors need to know. I only mention it because you may come across it in things that you read. All right, so we've talked about duration and how that can give us an idea of how interest rates will affect a bond fund. There's another concept, though, that we can actually project the long-term returns of a bond fund. And I'm specifically talking about a bond fund that maintains the average maturity of its bonds. In other words, they're buying and selling bonds so that they keep, say, their bonds in that intermediate term, or it could be short-term or long-term range. So again, if we go back to Vanguard's Total Market ETF bond fund, they're trying to keep their maturity roughly, you can see it's 8.8 in that range. And so they're going to buy and sell bonds to maintain that range. And the effective duration tends to stay in that same range as well. Given that, well, there's a little formula we can use to kind of project the long-term performance of this fund. And here's what we need to understand. As interest rates rise, we know that bond values go down. That's the bad news. There is a silver lining. Because interest rates have gone up, when a fund like B&D sells and then buys new bonds, they're buying new bonds with a higher yield because interest rates have gone up. So yeah, we've lost value of our bonds because interest rates went up, but eventually the higher yields will sort of fill that hole and will eventually break even. The lower valuations will eventually be offset by the higher yields. And that raises sort of the question that I was getting at. How long does that take? Can we use duration to figure that out? Well, yeah, we kind of can. There's a little formula, and there are different versions of this, but the one that I tend to follow is this. We can take the duration of a fund like this, double it, and then subtract 1. So we'll just round this up to 7 years. We double it, goes to 14 years, and we subtract 1. That gives us 13 years. And what this formula tells us is that over the next 13 years, this bond fund should return about 1.9% a year. That's factoring in interest that we earn, as well as the change in the underlying bond values. So 13 years, this bond fund roughly should return, again, total performance of about 1.9% a year. And I suppose in 13 years from now, we can all look back and see how accurate that is, but it's really more of a mathematical analysis, not some guesstimate. Again, it's a rule of thumb, but it's a pretty good rule of thumb. And that really raises the big question. All right, Rob, if you're telling me that a fund like B&D, which is used in a lot of 3-fund portfolios, is going to return about 1.9% a year over the next decade or more, why in the world would we ever invest in it or any other bond funds? I mean, that's about as appealing as Brussels sprouts, right? And not the grilled kind that we all like. And so that's a good question. But it raises an important second question, and that is, well, what do we think stocks are going to do over the next decade or so? And in fact, when we look at dividend yields and the current valuation of stocks, they don't look much more appealing. And in fact, I think most people say, look, we don't know when the market's going to turn, but when we look over the next decade, we're not expecting returns to be that great. When we look at historical analysis of the market, when dividends yields are as low as they are now, and valuations are as high as they are now, the 10-year outlook on stocks are not great. And so, yes, the bond market is not yielding much, but frankly, stocks aren't looking much better over, again, the next decade. And so, yeah, bonds, maybe not exciting, but stocks could do as bad or even worse over the next 10 years as well. That's not a prediction, but it's simply saying, look, given where valuations and yields are in both the bond and stock market, they both look primed for a very poor decade. Now, I still think bonds should be part of a portfolio. I'll explain why in a minute. But before I do that, I want to talk about two things. The first is when we talk about duration and that 2 times duration minus 1 year formula for sort of forecasting the returns of a bond fund over, in the case of B&D, the next 13 years. Keep in mind that assumes you either invest or have a lump sum in this case B&D, and it stays there in our hypothetical for 13 years. I point that out because many of you, particularly if you're not near retirement, you're dollar cost averaging. You're investing money in your 401k every paycheck, or maybe an IRA every year, or a taxable account. And so as you invest in a bond fund like B&D every month, every quarter, every year, you're going to be buying in at different yields and different prices. And so the formula that I've mentioned doesn't apply. Your returns over the next 13 years will depend entirely on how the bond fund does over that time. And there's no way to predict exactly when it's going to fall, when it's going to rise, when interest rates will change, how the yield will move. And it's really the same with stocks as well. As many know, the first decade of this century, the stock market as measured by the S&P 500 was pretty flat. But if you were just starting out as an investor, you actually did pretty well because you were buying as the market was going down. And then when it came back up, you performed, your portfolio should have performed very well. The same could be true with bond funds over the next decade. So if you're dollar cost averaging into a bond fund over the next decade, these formulas that I've mentioned don't really apply. All right. The second thing is, and that is that not all bonds work the way I've described, and the important exceptions for us are those bonds that are linked to inflation. And in the United States, those principally are I bonds and TIPS. And let me talk briefly about I bonds, but then our focus is going to be on TIPS. So the way I bonds work is you invest in a bond, an I bond, and you have a fixed interest rate, which right now happens to be 0%. But then you have a rate that gets adjusted every 6 months based on the consumer price index, inflation. And so as inflation goes up, that adjusted rate, of course, goes up, and as inflation goes down, it goes down. Currently, I bonds are paying over 7%, about 7.12%, I think, because inflation has ticked up this year. So right now, I think I bonds are probably the best risk-adjusted investment out there. Now, this isn't an I bond video, but just a couple quick things to note about I bonds. First of all, they can't be sold on the secondary market, so you won't find an I bond mutual fund or an I bond ETF. They don't exist. You have to buy I bonds yourself directly from Treasury Direct. You're limited to $10,000 a year. You can actually add another $5,000 as part of if you use part of your tax refund to buy them. But other than that, you're limited to $10,000 a year. And for the first year, you can't take the money out at all. After that, until year 5, there's a penalty if you take the money out early. So you got to keep those things in mind. But I own I bonds. I think, particularly now, I think they're an excellent investment, and I'll be buying more this year. And my wife will be buying some this year, even though she doesn't know that yet. And so that's I bonds. TIPS, unlike I bonds, TIPS, Treasury inflation protected securities, can be sold on the secondary market. So there are TIP mutual funds and ETFs, and we're going to look at some of them in just a minute. But they work a little differently. Their interest rate is fixed. Unlike I bonds, where that adjustable portion of the interest rate can rise and fall with inflation, with TIPS, the interest rate never changes when it's set by the government. But what does change with inflation is the value of the bond, the principal amount. It can go up when we have inflation. It can also go down. And as it goes up, this fixed interest rate gets applied to that higher principal balance of the bond. And then when the bond matures, you get that increased higher amount. So it adjusts with inflation like I bonds do, but in a very different way. And here, and this is really important, we talked about this, but you don't want to confuse yield with the total returns of a bond fund. In the case of TIPS, they're yielding negative let me show you this. We looked at it briefly a minute ago. This is the Treasury direct website. Here's the tips tab. Look at the yield, minus 1.145 on a 10-year bond, 5-year bond yielding, it's even worse, negative 1.685. Here's a 30-year. Imagine locking your money away for 30 years at a negative yield. So these bonds, tips, right now have a negative yield. But when we look at an intermediate term Treasury fund, a tips fund, and let me give you an example. We'll look at these more in a minute, but I'll look at, this is the iShares. Let me refresh this page. This is the iShares tips bond. And look at this yield, it's 3.64. That seems like, how does that work? And if we go to the the performance tab, look at this, year to date, it's returned over almost 5.5% year to date. And so here's the deal. Again, remember, at auction, they could have a negative yield, but as inflation goes up, which it has this year, the value of the bond, the principal amount goes up. That's good for investors. And the interest gets applied to that larger amount, which of course increases the interest payments. So this year, even though at auction, these tips have negative yields, because there's been inflation, tips funds have generally done pretty well this year. Again, we'll look at those in a bit more detail in just a second. Now, having said all of that, one thing to keep in mind between tips and say treasuries. So you can think of a tips as a treasury bond, but with sort of an insurance policy that insures you against inflation. That insurance policy, though, comes at a cost. What's the cost? Lower initial yields, like we saw, actually negative yields. So you pay for that insurance policy. And the question becomes, well, is it worth it? Which ones will do better? Well, it's pretty simple. If inflation turns out to be higher than the bond market expects it to be, tips will have been the better investment. And if inflation turns out to be lower than expected, treasuries will be the better investment. And I know you're thinking, okay, Rob, great. Which one is it? Well, the answer is there's no way to know. And we can actually address that issue when we construct our bond portfolios, which we'll do in just a minute. So having said all of that, and if you're still watching after it's been 42 minutes, thank you. You're real troopers. Why invest in bonds at all? We know long-term stocks outperform. Yields are at historic lows. Yes, dividend yields are low too, but bond yields are historic lows. And when they go up, except for maybe these tips bonds, we're gonna apparently lose some money. Long term, it doesn't look great. And I think there are at least 4 reasons why I think just about everyone should have some exposure to bonds. First of all, if we want to look at the current market, yes, bonds are expensive, which is just another way of saying their yields are low. But as I mentioned, all assets are expensive. The S&P 500 dividend yield is extremely low, about 1.2%. Valuations are extremely high. The outlook for U.S. stocks are not great. It's very conceivable. We don't know, but it's very conceivable that bonds could outperform stocks over the next decade, like they did the first decade in this century. So that's the first thing. The second thing is bonds add, I think, needed diversification. Particularly the kind of bond funds we're talking about, that when stocks really take it on the chin, bonds can soften the blow. We saw that with COVID just a little over a year ago. And so a lot of times when stocks fall, bonds rise. Now, the exact relationship depends on the type of bonds and the particular market, but the diversification benefits of bonds are extremely good. Third reason, this is particularly important for those like me that are in or near retirement, capital preservation. Yes, bonds can lose money, although we can manage that, as we'll look at in a minute. But by and large, they don't lose nearly as much money as we know stocks can lose. And so capital preservation, particularly with shorter term bonds, maybe intermediate term bonds, I think is really important. And then the fourth reason is just generating income. Now, again, right now, bonds aren't generating much income, but for those that want to generate income, thinking longer term, bonds can certainly play an important role. Keep in mind, even for long-term investors, that there are many periods of a decade or more when a 90-10 portfolio, that's 90% stocks, 10% bonds, or even an 80-20 portfolio, has outperformed a 100% stock portfolio. Sure, when you look at 30, 40, 50 years, 100% stock portfolio wins out. But when you look at 10 years, maybe even 15 years, there are times when a stock bond portfolio actually outperforms. And so I think there are a lot of good reasons to invest in bonds. And then the question is, all right, how do we do it and what do we invest in? So here, I think for long-term investors, think folks that are 20 years or more away from retirement. My personal preference, what I followed, was a portfolio of 90% stocks, 10% bonds. Now that doesn't mean that if you're listening to this and you say, Rob, I'm not convinced I'm 100% stocks, that I think you're making some grave error. I do think you need to understand the risks of that portfolio and that it could underperform a 90-10 portfolio over a fairly lengthy period of time. I also am not suggesting that an 80-20 or even maybe a 70-30 portfolio is a huge mistake for a long-term investor. But what I'm saying is that for me, I found that 90-10 portfolio, if you've got at least 20 or more years to invest, was sort of the sweet spot for me. It's also where a lot of target date retirement funds end up. So let's start there, and then I'll go to folks that are in or near retirement. For those that are 20 years or more out, what might you consider investing in? And I think there are a couple of options. The first we've already looked at is the total bond, Vanguard Total Bond. This is their ETF version. They have a mutual fund version as well. As we've looked at, it's got a 12-month yield of 1.9. Its portfolio consists of some government bonds. These are treasuries, some corporate bonds, and some securitized bonds, think mortgage-backed securities. It's all investment grade or higher. We can see that right here. BBB is the lowest allocation they have. It does have an intermediate term duration. So if interest rates go up, you will lose some money. But again, if you're a long-term investor and you're dollar cost averaging, you'll buy into this fund when yields are low. You'll buy into this fund when yields are high. And I think it's a great all-around fund. It's one I've invested in at various times over the years. Now, it's not the only option. Again, I'll leave links to all this below the video. Schwab has a very similar bond fund. Its last 12-month yield's a tad higher, 2.18. If we look at its portfolio, very similar. Same, government, corporate, securitized, all BBB or higher. Similar duration, very similar fund, very low expense ratios. Now, this fund is a little different. It's similar, but there's an important difference, and I think this will help in understanding how to evaluate a bond fund. Now, FBND is the ticker. This is from Fidelity. And if we go to its portfolio, at first it looks very similar, right? We've got our government bond percentage here, corporates here, securitized here. But you'll notice if we go over to back to Vanguard and Schwab, this style box, it's the same for Vanguard and Schwab. That is to say, the same sector is highlighted. What does this mean? The row tells you credit risk. Remember, we talked about credit and interest rates. So this has the highest credit quality, which means it's basically invested in investment grade bonds and U.S. government treasuries. And the row tells you its interest rate exposure. So this is an intermediate term bond fund. We see that with the duration, so it's in the middle. Schwab is the exact same, but notice Fidelity. It's an intermediate term fund as well. Duration's about the same, but its credit is now in the middle. It's slightly lower credit quality. And in fact, when we come down here and we look, we can see, yes, sure enough, this fund invests some in what would be considered non-investment grade bonds. This would probably be at the corporate level. Now, it doesn't invest a lot in below investment grade bonds, but it does invest a little. Now, the question becomes, well, Is that good or bad? I think this is a perfectly good bond mutual fund. One could argue it gives you even a little bit more diversity than the other two because it invests in some high yield bonds. And that's certainly a reasonable argument. For me personally, I don't want any excitement in my bond fund. That's what I have stocks for. And high yield tends to behave more like stocks than bonds at times. So for me, I would personally go with either a Vanguard or Schwab fund in this example, not the Fidelity fund. But I don't think the Fidelity fund is a mistake. You may decide to take a different approach. The reason I showed it to you was just to show you that difference and sort of how to evaluate these different bond funds. So I would use any of these three. Again, I would probably prefer the Schwab or Vanguard fund, but any of these three would be perfectly good bond fund solutions for long-term investors that wanted, say, 10%. In my case, you might have a little more, a little less in bond exposure. It's well diversified. Now, you'll notice there's one thing missing in all of these bond funds: tips. And that raises the question, shouldn't we have tips in our portfolio? I like tips. I think they're really important for reasons I'll explain in a minute for those in or near retirement. If you wanted to keep things simple though, and you were a long-term investor, I think just having one of the three funds we looked at would be perfectly fine. Having said that, tips, as we've pointed out, protect us against inflation, right? So when inflation goes up like it has, and if interest rates follow, we know like a BND or the other bond funds we looked at, the values are going to go down. But with tips, we know the inflation is going to actually drive up the values. And so particularly for folks in or near retirement where you're starting to draw on your portfolio to live on, I like the sort of inflation protection that tips give us. And that raises the question, well, then do we go with all tips? How do we decide what to invest in? And here, I like to follow sort of the path that David Swensen, who passed away not that long ago, but he ran the Yale Endowment for many years. And what he said was sort of a starting point in a bond portfolio would be 50% in sort of a normal bond portfolio like a BND, for example, and 50% in tips. Remember, we've talked about if inflation is higher than we expect, tips win. If inflation is lower than we expect, nominal bonds, BND, or even a Treasury bond fund, we'll look at some examples, they win. I'm a firm believer there's no way to know. There's no way to predict interest rates. I can't predict what interest rates will be tomorrow, let alone what they'll be 5 or 10 years from now. And so I think a simple way to sort of cover your bases is 50% in either sort of a total bond fund like we looked at, or an intermediate term Treasury bond fund. We'll look at some examples. And 50% in tips. That's an approach that I feel very comfortable with, and it kind of covers your bases either way. Now, for you long-term investors, you may be saying, well, I don't understand, Rob, if that's good for people in retirement or near retirement, why isn't it good for me? It absolutely is. I think it's an absolutely reasonable approach to bond investing. It just requires at least 2 bond funds. So if you wanted a 3-fund portfolio and you're in your 20s or 30s and you only want to deal with one bond fund, then a BND or an SCHZ, that's Schwab's fund, might be the way to go. If you're willing to add another bond fund, I certainly think a 50-50 allocation between a nominal bond fund and an inflation-adjusted tips fund is a great way to go. And it's sort of my preferred approach these days. So we've looked at sort of total bond fund options, 3 of them. What I want to show you just very briefly, again, links below the video, are 3 tips funds to consider and 3 intermediate term Treasury bond funds to consider. And before we look at them, let's talk about, should you go with Treasury bonds or like a total bond fund? Well, again, I think both approaches are reasonable. A Treasury bond fund is going to have virtually no credit risk at all, right? Whereas the bond funds we looked at, their credit risk may be low, particularly for the Schwab and Vanguard funds, but there's still some credit risk there. And so these funds can get hit a little bit as we enter, say, a bad economic cycle. It's not that one is better than the other, you just have to pick. And I think both approaches are reasonable. I tend to like the total bond fund approach better because it gives a little more diversity. It includes treasuries, but a little of some other things. But I think both approaches are reasonable. All right, so with that, let's take a quick look at several of these options. This is the Vanguard Intermediate Term Treasury. So this is not TIPS. This is just a Treasury bond fund. You can see it's yielded 1.15 over the last year. Its portfolio got a duration of 5.4, and it's probably lost money this year. Let's look at performance because interest rates have gone up. Yeah, so it's lost 2% this year. So we have to understand these can lose value. Here's the Schwab Intermediate Term. Its yield is 1% the past 12 months. By the way, all of these are low cost. This happens to be 5 basis points. We can jump over to its portfolio. It has a duration very similar to Vanguard. It's a little over 5 years. And I'm sure it too has lost money this year. Yeah, about the same, just over 2%. And Fidelity. Here its duration is 6.71. One quick note about Morningstar. This is a mutual fund. Schwab and Vanguard are ETFs. Why do I mention that? Because where you'll find the information is a little different. On this quote page, for an ETF, we don't see duration. We've got to go over to this portfolio tab to find it. And it's right here. With mutual funds, for some reason, they give us the duration on the quote page, on the sort of home page of the fund. Now, I'm sure the portfolio page has it as well. Yeah, right here. So let's just understand that Morningstar puts information in slightly different places when you're looking at a mutual fund versus an ETF. And if we go to performance, I'm sure this fund has lost money. Yep, just a tad more, 2.31%. And it could be, again, differences. This one has got a slightly longer duration, which would probably explain the difference, slight difference in the returns for the year. That's treasuries. Now, remember, interest rates have gone up. There's inflation. Or I shouldn't say interest rates have gone up. There has been inflation. Inflation has ticked up. That helps TIPS. So this is an iShare TIPS bond fund. We can see its yield over the last 12 months has been 3.64%. We can look at its portfolio. It's got a duration of 7.65 years. And its performance, year to date, 5.5. We can see that right there. Schwab has a good intermediate term TIPS fund as well, just 5 basis points. Its performance this year, about the same, 5.61. Vanguard, this I believe is, this is VIPSX. It's a mutual fund, so there's our duration on the homepage, if you will, of this fund on Morningstar. And its portfolio performance should be roughly the same. Yeah, 5.5. So again, we can kind of see in action the concepts we've been talking about. Inflation went up, interest rates have sort of ticked up a little, but then they've come back down. But because of that, nominal treasury funds have gone down in value while TIPS have gone up. Of course, the reverse could happen, right? As inflation could end up being more transitory or could settle back down. Interest rates could settle down and TIPS could underperform and treasuries could go up. That's really the point of my approach to bonds. I don't know which is going to happen or when. And I'm not dollar cost averaging as much as I was when I was 20 because most of the assets we already have. Even as I continue to save a little bit more each month, the vast majority of what we're investing is already invested. And so how I play the bond market is really important. My approach is 50% in a nominal bond fund. I tend to pick total bond funds, but I've also had treasury funds as well, and about 50% in TIPS. So that's it. A lot of folks have asked a lot of questions. I hope I've answered them. I know this has been a long video. If you've watched the whole thing, we're right at 1 hour, and I appreciate it. Again, you'll have timestamps below the video. I'll also link to all of the resources. And if you have any comments, leave them below the video. I'll do my best to help you out any way I can. There you go. Until next time, remember, the best thing money can buy is financial freedom.